Hello and welcome everyone to the Capital Mind podcast. If you'd like to know more about us, visit capitalmind.in, and if you'd like to invest with us, do visit capitalmindwealth.com.
This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Clients of Capital Mind may maintain positions in the securities discussed in this podcast.
Hi and welcome. This is Capital Minds Podcast episode 41. Today we're going to talk about term insurance, and we have with us a guest who's been with us before, Ruchir Kanakia from OneAssure. He's the CEO and founder at OneAssure.in. He was with us. We had a podcast together on insurance in, I think, episode 32 last year, roughly about September of 2020. It's nearly September 2021. Welcome, Ruchir, to the show.
Thanks, Deepak, for having me.
Awesome. So we have a lot to discuss about a subject we keep talking about at Capital Mind, primarily around the concept of insurance is not investment. Don't invest for the concept of insurance. But what should you do? You should actually insure yourself. The viable option we tell everybody is term insurance. But obviously, Ruchir is the most knowledgeable person in insurance that I know, and they've just got an insurance broking license as well. So I thought maybe coming from the horse's mouth, Ruchir, what is term insurance?
Term insurance, simply put, is if you die, your family gets paid, or your dependent or your nominee gets paid. Simply put.
Perfect. So obviously there's more to it. So how does it work from a insurance company perspective? Why do they do it? What's their this thing? And then from the insured's perspective, of course, we have that as a
Let's take the insurer company's perspective first.
Yes.
And from an insurance company's perspective, right, it's pure protection, which means pure insurance, right? Like they don't have to return any money, and the premium earned directly hits them as revenue on their balance sheet. Profit and loss.
Yes.
Profit and loss statement. So from their perspective, the reason why they would want to do this, because this is one of the profitable products they have, right? And it's basically, they don't have to, even if you discontinue your policy, they're not going to return any premium back to you. The only way they have to pay any amount to your dependent is the eventuality of death, which happens in the stipulated contract period.
So you have a term for which the contract is created, and then you kind of negotiate. But then, how does an insurance company even price this thing?
So there are various factors, right, to price this, right? In evolved markets like the US, they can price it based on the location you live, based on whether you smoke or you don't smoke, based on any pre-existing medical conditions you have, based on the factors in the environment which affect you, which you grow in, right? But in India, primarily they price it based on pre-existing conditions and whether you smoke or you don't smoke. And that is probably also the reason, because we don't have enough data here to price risk accurately. So this is fundamentally, we are relying on mortality rate calculations, which God knows how outdated have they become, or whether they have even gone ahead and factored in a possibility of a pandemic, which we all did not do for the last more than 50 years, right? And that's where the crux is.
I think that's interesting, because when you're coming to a pandemic situation, you're saying that basically if you thought last year that my possibility of a person dying, or the possibility of a person dying was based on how long he's lived so far. So if he's 50, he's unlikely to die next year. But now if the pandemic comes in and changes all of that. So in this case, the company itself prices its risk based on some mortality tables, like you said, certain factors, but they don't take all the risk, right? The insurance companies also palm off some of the risk to somebody else.
Right, that's where reinsurance companies come into play, right? Majority of the term insurance which is bought in India, right, has the risk is actually transferred to a reinsurance company. But these reinsurance, there may be thousands or tens of thousands of insurance companies, but unfortunately the number of reinsurance companies is maybe max in tens or hundreds across the world, right? Now the risk is concentrated with these guys, and these guys are crunching data to figure out and to predict how long all of us are going to live.
I see. So now they're kind of taking that assumption off of the
Yes.
insurance companies and becoming the reinsurer. So an example would be perhaps Berkshire Hathaway in the US.
Yes,
And
Berkshire Hathaway, Swiss Re, Munich Re, these are like renowned reinsurers, right? And to a large extent, the current pandemic has been like an eye opener for them, because now they will have to price in such events occurring more often than they have in the past, right? And no one knows how this is going to change the entire pricing in this industry today, right?
perfect. Yeah,
Right.
you wouldn't have an idea before this.
And from an insured person's perspective, right, to come back to your question, if I were to say that you're buying term insurance to protect your downside in case you die, right? And because you want your family taken care of and you want your debts to be taken care of. These are the only reasons you're thinking of buying a term insurance.
So dependence and debt. So
Debt.
that is your two criteria for saying,
Perfect.
buy. This is great because now
D square, if you
D
want
square,
to.
if you may, debt. I mean dependence and yeah,
Debt.
this is important, and I think we'll come back to it more as we go along. But the next part of it would be like, how does one buy it? Like for instance, how much is needed for a person, and how much can you get at one level? And for how long? So do you buy the term insurance till 100 years from now, or
My way to answer this question would be, you buy term insurance until you expect that you're going to generate income or you're going to make money, right? So that technically for a salaried employee will be retirement age. For a self-employed will be his ability or his willingness to work till what age, right? And if that in most cases that age is around 60-65 years, right, because then it becomes really difficult to get up every day in the morning and go to work. So that would be the maximum age for which you would want to buy term insurance for. Typically, there is a misconception that people buy term insurance to claim that eventuality I have to get a claim, right? We Indians have this thing that we cannot like see money going out and we not getting anything in return, right? So that's where majority of the people get it wrong, because you're buying it so that that event never happens to you, right?
precisely. No, in fact, I mean, how could you rather die than let the money go waste? So
Yes.
I mean, it doesn't sound right, but you're right. I mean, the framework of thinking is somehow I should ensure that my family
This
gets
money does
something.
not go waste, because we are very value conscious as a country, right? And if you see that we are trying to derive as much value of we are trying to get a bargain, or we are trying to get money, and we won't leave an avenue where we will leave money on the table.
Yes, and I mean, in fact, that causes us to lose more money because I think the 100-year policy will be significantly more expensive, right? So
Exactly, right? Because the probability of the number of people who will live till 100 age is very minimal, right? Like especially in a country like India, right? So that means that the insurance company is definitely going to have to pay you that amount.
So it will price it accordingly. It will say, Acha, okay, if you're giving me a 1 lakh rupees of
Yes.
cover, for that 1 lakh, I will charge you, I don't know, maybe 1,500 or 5,000 rupees a year. Because in 20 years, I'll recover all that I need to
Yep.
be
So
able to
we've covered the how long. The how
much.
much is the bigger question, right? And that typically depends on what sort of income you're generating and what you're doing to generate that income, right? And there are two factors: how much we want to buy and how much does someone want to give us. And here,
Yes.
the someone want to give us is the insurance company, right? And as we discussed earlier, these insurance companies are relied on certain reinsurance restrictions to based on which they can take an exposure on you. So typically, the thumb rule is 10 to 25x of your income is what you typically get, which an insurance company is okay to insure your life for. And if I were to, for a self-employed person, this is basically 3 years average ITR is taken to calculate the accurate annual income, average of last 3 years ITR. And for someone who's salaried, it's just last 3 months salary slip.
That's it.
So if you're a salaried employee who's going to become non-salaried, it is better that you buy the insurance before you quit your job, in my
I see.
opinion,
I see.
right?
Because you won't have 3 years of an ITR, you might as well do it before. Okay.
You
Awesome.
will have 3 years of an ITR, but then you would typically, folks who are salaried, right? Insurance or reinsurance companies are okay to take a higher multiple of risk in terms of the sum insured. Versus if you're self-employed, because the business you're going to be affected by the ups and downs. Your income is going to be affected by the ups and downs of your business. So that is also factored in.
Got it. Got it. Okay. So, I mean, we did a rough calculation using plan also for the how much. The rough calculation was for every lakh rupees of expenses, non-debt expenses, you would actually take, say, about 1.5 to 1.8 crores of insurance for someone who's 30 years old.
For 30 years old.
Assuming
Yeah.
that you live on till you're 90 and so on, we have a calculation on that. But there's an interesting aspect over here where you talked about once about what about if you have a loan? So
So typically, right, when you have a loan, the company who's going to loan the amount to you will insist that you buy a policy at the time of get as a condition, a precondition to get this loan, right? This was not a norm earlier, but now more and more in the last 5 to 10 years, this has become a norm. Now, if you have an existing term policy, you can go ahead and as long as the tenure of your loan is lower than the tenure of the policy which you hold together,
Remaining tenure,
you can
yes.
assign the policy and thereby save the cost, right, of buying a new insurance. Because every year which passes, the life insurance cost is only increasing, right? It's never going to come down because of age also and inflation as well and other factors. So that is an option. Otherwise, the insurance, the loan provider, NBFC, would typically have worked with an insurance provider to create a plan for people who avail this loan. And here the loan provider will offer you this option.
got it. So your loan provider, who basically says, listen, you have to take an insurance policy. Either you reassign one of your, and this concept of an assignment is in case you die, the money goes to the insurance company, to the lending company.
Lending company.
And then whatever is left, they pay you back.
The balance,
on the next of
depending
kin
on,
back.
because you've taken the the policy for the entire loan amount, right? Now you would have paid back. You died in the 5th year or 10th year. Based on that, you would have paid off a certain percentage of your loan.
Correct.
Right. So the delta will be there over there.
Yes.
So that money will go back to you or will go back to your beneficiary.
And of course, if you've paid off the loan, you can shut down the term insurance, saying that part of. So I could have multiple plans. One is for my family to be taken care of after I die. One is for my loan to be taken care of when. So it could be different policies. I can shut down one. I can keep the other on.
So I would insist that if you have debt, right, take out a separate policy just for that debt and keep it separate so that you know that this policy you can ensure that you stop paying for this policy the moment your debt is taken care of.
Perfect. Yeah,
Right,
makes
like
sense. Yes.
debt and dependent. So we can technically say that people can now have two policies, one for their dependents, one for debt.
Perfect. No, it makes sense. I mean, especially if as you go along, the other part of this would be, can a person who does not have an income, of housewife, buy insurance?
So typically they can. There are joint policies where a husband and wife can be insured, but they come on based on certain terms, right? Like based on husband's income is used as a proxy for wife's cover.
Got it.
Right. And typically if husband is getting a 1 crore cover, the wife would get a 50 lakh cover if she does not generate an income. Right. And that is the only way for you to now insure a dependent who is not income generating.
Perfect.
Because when you buy a term insurance, you have to do financial underwriting and you have to do health underwriting. Financial underwriting cannot happen if you're not income generating at all. Hence, the husband's income is used as a proxy.
This is interesting because if you come to a point where you're saying that there is insurable interest in your but your spouse who is not income generating does not have any insurable interest independently of you, that means you cannot buy an insurance independently for your spouse, despite the fact that if she or he is not there, the other spouse has to take a disproportionately larger cost in terms of children maybe and all that stuff.
Unfortunately, that is how the
insurance
industry is.
works. Yeah.
Like one of the biggest gaps is that how would someone insure someone who does not generate income, right? And what is the cost of like life then, right? That comes to, and how do you price it, right? And what sort of amount do you now insure someone's life? Like
Because
what is
it's so
worth?
open-ended, they might as well said, listen, no, we're going to go with actual income rather than perceived loss of income or whatever and
Yep.
all that stuff. Okay.
It becomes very difficult to price
To
it.
price
And then what happens to the premium, right? If the someone is not income generating, how does he now pay premium? Where does he generate income to make this payment of premium year on year to end?
in the first place, yeah. But then this comes down to payment terms. So, for instance, if you have a payment term, can you have a payment term of saying I'll pay every year versus I will pay only for the first 5? Can I do something like that?
Yeah, so all the insurance companies, right, let's start from the lowest term, right, which is monthly.
Okay.
Monthly, quarterly, 6 monthly, yearly. Then they have something called as limited pay. In limited pay, it can be one shot payment, 3 years, 5 years, 10 years, right? According to me, the most optimal payment mode which you should opt for is yearly. Because if you do monthly, quarterly, 6 monthly, they are technically charging you premium for paying in those intervals.
Yes, they
like
charge
interest.
higher, yes.
Yeah, the interest it gets rate, but a yearly is the most optimal way to pay your sort of because a lot of us, right? Like I've had folks who ask me, ki, I don't know about the next 10 years, but I know I'm making this XYZ amount of money. So why don't I just pay it for the next 3 to 5 years, and the cover term can be 30 years. One important thing most of these folks miss out is that in 10 years, if you achieve your financial goals, you don't need the term insurance, right? So you can stop paying premium. But if you've prepaid, then it's already paid for. There is no way to get, like the policy is there.
This is like the Club Mahindra of insurance policy.
Yes.
Right? You pay, then you have to use it whether you like it or not.
You don't like it.
And, or whether you need it or not in this case.
Exactly.
It's a very interesting offset. But, there's one part that I think you had mentioned, which was very interesting. While you take the policy and you decide the term upfront and you decide the amount upfront, there is no change afterwards. So, for instance, you lose your job after you take the policy, that policy will still continue despite you're not having an income,
Yep.
right? So that part is clear. So, in the sense, anything that happens after the signing of the contract is not going to affect the contract itself.
As long as you pay the premium.
As long as you pay the premium, which I agree with. Now, but did say that there is a possibility of some part of it changing. For instance, you're a bachelor and you got married after a few years and you've taken a term policy on yourself after you got married. After 5 years, you had a child. Now you can at this point do something, right? Which is not
Yes,
something
because
that's well known.
some policies allow you to increase your coverage because you have added a dependent, right, in your family, and they have time periods in which, based on every company, you have to notify the insurance company, and your sum insured is increased. Now, the increased sum insured is priced based on the age where you request for this increased sum insured. And only the delta is priced. So it's like, let's take an example, right? 1 crore is the base sum insured, and now you're increasing it by 50 lakhs. So only the additional premium of 50 lakhs is priced at the age. You bought the first policy at 30, and the dependent was born at 35. So at 35, for the balance additional 50 lakhs, whatever is the price will be added. And the good part about here is that you don't have to go through the health underwriting again. Right, so this additional premium can be bought by just doing a simple endorsement.
This is interesting because now I don't have to go through a medical test again, and I effectively get a new insurance policy for another 50% simply by just paying the extra premium on top of it. But this health, I mean, help us understand this. For a investment type of policy, they don't usually insist on health checks and all that, but for term they do. What do they do in these health checks, and is this relevant for you to declare everything upfront and all that?
Absolutely, yeah. It's super important for you to declare everything upfront. Don't misrepresent any fact, right? Because it helps the insurance company price risk, if you were to think about it, right? If the risk is as accurately priced, the better it is, because the fulfillment of the contract holds on us being honest to each other.
Got it. Got it, got it. So you actually price the, so you have to say, for instance, I have asthma. Although they may not discover that you have asthma for a long time, it's better to declare it upfront
Perfect. And it's also better to insist on a full medical checkup, right, at the time of
so
term
they can't.
insurance, because that is always a choice which you have as a when you're buying term insurance. Like when you do a telemedical and maybe you forgot something, you don't leave it to a chance, right? Because you're thinking long term and you're thinking about an eventuality which most of us don't want it to happen. So you rather be sure right now, because the problem is that if you misrepresent anything, and it not everyone wants to misrepresent knowingly, so it can also happen unknowingly, right? Because if you didn't know, how can you represent something which you did not know? So it's, I would say, I insist that if given a choice, please go ahead and do a full medical checkup and then buy a term insurance. That way you're sure, the insurance company is sure.
Got it. In fact, I mean, I took my insurance. I was 42, and I went through one of these things, and they told me you have to do a treadmill test and
TMT.
something TMT and with some ECG, and I was like, why? But I said I'll do everything, but don't tell my family later because I won't be there. That this person was unhealthy from the beginning, so you better know how unhealthy he is right from the start. So no, interesting. So coming back to this, there is also obviously a point where I think you would say, if I asked you, Ruchir, do I need life insurance? You would look at me and say, no, you don't need it. So what are these, you know,
Yeah,
points?
I guess if you don't have debt and you don't have dependents, then I don't think so you need life insurance.
So essentially, what you're also saying is that don't buy insurance for children because children don't have any debt or dependents. Don't buy insurance when you've reached a point where your dying is not going to cause, because you have enough savings to be able to take care of your
Yep.
family, to be able to take care of themselves. You don't have any loans. So essentially, don't buy in these circumstances. And if you already have insurance, is it okay to shut it down at this point?
Absolutely. Like that's what most of us don't do, right? At the end of it, because we are so used to, yeah, the policy is there. Let's just, like, no one reevaluates after 15 years after buying the insurance that do I still need it, or, and if I don't need it, why am I paying for it? Right. And that becomes like a very difficult decision because you've set up an SI or a standing instruction or something and it is happening, and you just wake up one fine day because of some trigger in your life and want to reevaluate it, or you think about this.
Yeah, you have enough money, so it's not like it's a good point. But then let's come back to, okay, assuming you do need it and you've reached a point where you do need it. Now you can go and buy this insurance through many mechanisms. I mean, one is, I know we've got insurance agents or brokers. Is one layer. Another one is the bank themselves, and so many others. Can you talk us through who?
Done here. So let's just talk through all the ways in all the people who are involved in the insurance value chain, right? And who these people are, and what role do they play, right? So the first person I would like to talk about in this entire value chain is the agent, right? An agent is nothing but a guy who's representing an insurance company and is trying to sell insurance to you. He's helping you answer the questions which we've answered just earlier in this podcast, right? Like how much cover do you need? What should be your payment frequency? He's going to help you make all of these decisions, right? And 99% of us need that help. So getting an unbiased agent is always, it's very difficult to figure out who's biased versus who's unbiased, right? So opt for an unbiased agent, and most of this you can figure out by asking him some relevant questions. This agent also sort of becomes the support during claims to your family, and if he's known and trusted, then that's that one person who you can call during the time, or your family can call, and he can help with the entire paperwork during claims. So that's one channel. Second channel is your bank, right? Your bank typically would have targets to cross sell products, right? And your bank managers and your bank branches are they get regularly transferred. Your bank managers get transferred, and your branch may change because you decided to move to another city. So I wouldn't say they are the best people to buy, because they don't understand insurance. They're just, it's one of the many things they're selling, right? So they may not be able to give you an accurate understanding. And most of them, when they are pitching this product, you will call someone from the insurance company to sell
I
it to you,
see.
right? Then there is also an option of e-term, right, which is you buy directly from the website. So if you've done your research, you know everything there is to know, and you have answers to all the questions which we're just discussing, right? You can go ahead and buy it directly on the insurance company's website itself. The cost difference is in single digit percentage basis, right? Like it's not going to be that much. But at the same time, the whole process of underwriting, scheduling the medical test, and knowing where your policy is stuck and all of that, you're completely relying on the insurance company. So that's where and once you get the policy, right, even during claims, you will have to follow the process on their website. So while you may be tech savvy, you also need to factor in that you're buying this for your beneficiary or your dependent or your nominee who you're nominating as the beneficiary of this policy. Is that person going to be savvy enough to be able to maneuver all the things you are being able to do it? Or would you like a help? Right? And that's where brokers come in, right? And typically brokers are an advocate of the customer, right? So they're supposed to be unbiased. So and technically if they do that job really well, right, they can be a great, it comes at a cost, right? Nothing is free, nothing is like a free lunch. So based on what sort of customer you are, which you know better than most people, you can decide from where to buy. But a bank is not the right channel to buy, or people who don't do this for long term, or who are not long term insurance sellers, or who've not been in the industry on the long term, are not the right people, always the right people to buy it from.
This, and technically you should buy insurance from someone who's younger than you, because they need to be able to outlive you to be able to provide you service or your next of kin service, right?
Yep.
So
Completely agree with you,
yeah,
Deepak, there.
it makes sense to buy it from a business rather than from an individual, because the individual may have issues, and then therefore. But quite interesting, because you've got those as one. But what about loan providers? The home loan provider will tell you, yeah, I want you to buy insurance, and most likely they'll sell you some insurance. But you said that there's problems with that as well.
Yep. So home loan providers, right? The interesting thing most of these guys will not tell you is that they make money off the insurance which they sell also with along with the loan, right? And that comes back to them as commissions, right? And most of us buy home loans. So anyways, with the loan, there's collateral on
Correct.
like which is a physical house, right? So technically they can recover that money, and they have their own terms to recover that money, right? And this entire amount, right, which they will ask you to take this insurance policy, almost 40 to 50% goes back to them. So if you have an existing policy, it's better to assign it, provided you meet the criteria. If no, then you can also insist to a loan provider, boss, I will get my own policy, right? Because there's a law that NBFC or they can mandate you have an insurance, but they can't mandate that you buy from them. So you can do your own due diligence, figure out what is the best way to do this, and then accordingly either assign your existing policy or buy a new policy for the specific purpose of this particular loan and assign it to the.
So you don't have to buy it from the home loan provider. You can buy it yourself and say,
You don't
I'm
have to
gonna
buy
use
it from
this.
any loan provider for that matter, whether it's home, car, or whatever different sort of loans you may have taken.
I see. Because I think a lot of people had that as an issue, and then when you finish the loan, they're supposed to unassign that policy so that you can continue with it in a regular
It's like a
basis.
very simple no objection
Certificate.
certificate, right? Or a letter saying that the loan is closed and you've gone ahead and collected the original documents of your flat or underlying asset. And the fact that the policy should be released and you should be able to go ahead and make your beneficiary the nominee here.
Perfect. Okay, so now coming to the next step of this process would be, we've insured against ourselves dying. But can you insure against other things? The riders, what are the different riders available in a term insurance?
Yeah, so
plan?
there are like plenty riders, right? Because the insurance company always likes more premium. So they will try to create new and new riders, and they will try to push it through, right, via their sales agents or via the different channels. I guess a pure term plan should be bought as a pure term plan. Two things, right? When you add a rider, one thing is that you cannot delete it.
I see.
There is a because it's attached to the contract for the tenure which you've taken. So delete or letting go of the rider becomes a problem. Or when you let go of your main policy, then also it's a problem because you may want to keep the rider, but you may not want the policy, right? Like we discussed that if you've met your financial goals in life and have like budgeted for it, and in that case, then you're now stuck. You are in a conundrum what to do. So if you keep it separate, at least you have a choice on what to continue, what not to continue. So typical riders are a personal accident policy, which can otherwise also be bought separately. Then there is another rider called critical illness, which covers a fixed set of diseases, right? And here I'll like to mention, right, like you need to read fine prints because what sort of diseases they cover and of what severity, right?
Oh.
And most people think that it covers it, and then they get a shock that okay, only of this particular severity this disease is covered.
So you're saying that, oh, if I get, for instance, if I cover, I don't know, cancer, but they'll cover one form of cancer but not the other.
Or they will say specified severity.
I see.
And then you have to figure out how they've defined specified severity in their fine prints, right? Ki what sort of cancer of what specified severity is this policy going to pay me, right? And also then there is the concept of return of premium, thinking that because Indians love to get the money back, but imagine this, right? You paid 5 lakhs for a 1 crore plan, say for 30 years or 40 years, and that 5 lakh is coming back to you after 40 years, but you've paid almost like more premium to the insurance company just to get that rider.
Yep.
Financially, it does not make sense. I guess, Deepak, you've done this
I
calculation
have,
yourself.
no, in fact, I personally bought one of these because I had that same thing of you'll give me my money back. I didn't even know of term at the time, but this was the cheapest one. It was 800 rupees per lakh. And I later found out if I had taken the regular term plan from LIC, it was 250 rupees per lakh. I was 22 or 23 years old at the time. So 250 versus 800 rupees per lakh is like I'm paying 4x nearly or 3x plus the premiums in order to just get my money back.
Yeah, but then, yeah, I get your point, right? Like, but that is what an insurance company will want to push, right? It's a rider because it's more getting more money out of the customer. So my honest advice is just buy a pure term plan. And also, if I covered it correctly, right, where if you're an informed customer and no matter what happens and you go ahead and apply directly to the insurance company, they will still try to call you and try to upsell stuff.
Which
Right.
is the riders. And
Yeah.
sort of.
Problem there is that people who are upselling stuff, uh, they are getting paid based on the ticket size of the client, which is you. Hence, the more they upsell to you, whether it's relevant, irrelevant, the more their incentives are aligned towards that. Right. So very few people, even in an insurance company, they have targets to meet. If you get paid. That is in case of any sales org, right? You have
Correct.
targets to meet, and then you go ahead and meet those targets, and you're put under pressure, right? So even someone who's genuine now is put under pressure.
Yes, I mean, I think you're right in the sense that eventually they will sell you some of this stuff. And to perhaps, like you said, perhaps the rider is available separately elsewhere. The one difference is you'll probably have to do only one medical to go through it here versus if you take two different policies, they'll require two different medical
Actually,
tests.
most of these riders don't require a medical. A PA policy typically does not require a
I
medical.
see. Oh, yeah,
A
that
CI
makes sense.
policy also, in most cases, may not require a medical. Right? So
So
90% of the chances are you'll get some of these policies without any medical.
this thing. So on that front, just to clarify, critical illness is probably the one thing in a term plan rider that pays you when you're alive, other than the ROP, the return of premium.
Yep.
So in critical illness, the idea is if you get cancer, they pay you a certain sum of money, and that money is supposed to take care of your medical treatments while you're alive. And after that, if you die, the term plan's sum assured will go to your next of kin.
You're
So
absolutely right. I forgot to mention one more rider called terminal illness, right? Like if terminal illness is what if you buy that rider, the premium is incremental. Some companies even offer it as free,
I see.
which means the moment they know that you've been diagnosed with a terminal illness and you're going to die in 6 to 9 months, the money gets transferred sooner than later.
Oh, the whole term sum assured. So
Exactly.
you can still get it when you're alive if you have a
Yeah,
terminal
but then you have to be terminally ill, which means
I
that you are.
just
Yeah,
yes,
yeah.
of course. No, the
But yeah, that
difference.
money is available,
Yeah,
but it
like
comes at a very fraction of the cost, or some companies even bundle it for free.
I
Like they
see.
price
I
it
see.
into their product itself.
So effectively, it's like saying, okay, it's not like Alzheimer's because Alzheimer's is not terminal. I don't know if it is, but they might define what terminal is. It could be a certain form of, say,
Cancer, where
metastatic
you know.
cancer or a certain kind of thing where you say, okay, listen, the doctors told you you have X months to live, and when the doctor has said it in such a fashion, you need okay. So then you get a certain sum of money straight to your bank account. You if you live longer, you still get to keep the money, and you don't have to
But so
return.
most of these cases are where the rider is built for cases where the death is eventual, and the span in which it's eventual is also very well
Well
prescribed
prescribed. So
and
it's like less
defined.
than a year
It's
or
well
less
defined.
than.
Yes, less than a
Yes.
year in most
I mean,
cases.
we know that now, of course, the technological development. So this is one of those things which could be, uh, you know, this is just me being Indian about this. You get your money back and you also recover and you become fine again. I mean, this is just such an off chance that it's not something.
Yeah, yeah.
It's
The
worth.
probability is like.
No, plus first, I don't want a terminal illness. Under any circumstances, don't. I'm not going to be terminal ill and recover just to get the money from my
Agree
term
with you.
plan, right? So, um, this is interesting. Now the point is, now let's say I have been, had a terminal insurance. I've gone. I die. What does my next of kin have to do? I mean, assuming that we're in the process of saying there has to be knowledge about the process. So what is this and what happens in these processes?
Let's take let's split it into two categories, right?
Mhm.
If the death has happened due to natural causes, then there are a list of steps you need to follow. If the death has happened due to unnatural causes, then a list of steps which you need to follow. In unnatural, there's an additional burden of an FIR and some record that you've gone ahead and complained, and you have a physical copy, which is
So
legally
like a
required.
car accident or a murder or a crime or a suicide.
Exactly, right? You need to, that is in addition to everything you need to do in case of a natural death scenario. In a natural death scenario, the process is very straightforward, that you need the death certificate, the KYC, the reason of death, if the person was hospitalized before, then all the hospital reports pertaining to it. And this is very straightforward.
So a discharge summary of sorts.
Discharge summary of sorts.
So
And every insurance company on their website typically mention all of this in very detail, right? Like, but the question is that what to attest, what not to attest, what forms to fill, how to fill, right? And because you're hassled, typically you seldom need help or you need assistance during that time. That it's not that you're not skilled enough. It's just that
your
you're not in
frame
the
of
state of
mind.
mind,
Yeah, yeah. I mean,
right? And you rather have someone help you maneuver through all of these things, right?
yes. And is there a time limit after death that you have to claim, or is it like
uh, at least the intimation needs to happen immediately, like in as soon as possible. Like if someone's died, someone needs to intimate the insurance company that the death has happened, and the claim, then they give you time to file. So one is an intimation, and then the claim
The
is
claim
filed
is-
once you've gone ahead and submitted the first set of documents.
so? Let's say somebody dies and they haven't even told their next of kin that they have this life insurance. This was discovered 6 months later. Is that a problem in generally?
It happens seldom, a lot of times, and because if you've died in that date, you'll have to look at your insurance provider's terms and conditions.
I see.
The safest answer to this is that, because typically they mention the outer limit in which they need to be notified, right now. What happens, like if someone had insurance, died and the policy was active, and 5 years down the line realizes that the policy was active and tries to claim, what happens in that situation, right? Because that is defined, and it's very well defined in most of their contracts.
Perfect. So then one needs to actually, it may not be in the contract that you have, but it could be in the website of the insurer saying this is the minimum
During the
time
claim
frame.
process, right?
Yeah.
Like, but in your case, it still does not apply, because if your beneficiary did not know the person has an insurance, he would not know which company the insurance is from, right? Because
Yep.
that discovery would happen much later, right? But there is always a specified time in which you need to inform the.
in the insurance. So, is there a place where a person who has died, the next of kin, can look up and say, okay, this person with this PAN number, is there a record of? I know that they are talking about dematerializing.
No, actually, that exists even today, right? But it's not widely being used,
Correct.
right? EIA accounts is an effort where CDSL and NSDL have these insurance
Correct.
accounts where you can figure out if you've logged your policy. So that's one way to figure out. That is if you link those accounts with the policy. So at the time of applying the policy, they ask you for that particular account number, or they create it for you if you need it to be created.
Okay.
But now, if you've not opted for it or if you've not created for it, then it's very difficult. And secondly, this means that you will have to go and approach a CDSL or an NSDL with the PAN card, figure out what policies are linked to this PAN card to even check some of these things. My best advice would be when you buy a policy and when you have a beneficiary, it is your duty to inform the beneficiary at
Right.
least about the policy and sort of like inform that person, which most of us a lot of times forget to do, right? And also, if you now change the beneficiary, right, or you change your nominee suddenly midway through the policy, at least involve tell all the nominees involved, keep them informed, right? Or like another simple way would be to just keep all your financials in one email account or in some folder on your computer and keep a track record and inform your chartered accountant of all of these things, right? Because that person can also assist, right? He's claiming tax deductions for you, so he
Yeah.
can be a proxy for you to now go ahead and
To
inform your family.
As well, this actually brings into another point we discussed earlier. If you pay single payment for an insurance company, the likelihood of your next of kin discovering that policy becomes lesser, because if you haven't done all the record keeping. Whereas if you are paying regularly, then at least there's a record every year.
Yeah, the natural thing is the person is going to look at the bank statement, right?
Correct.
And if the bank statement is looked at and you see that this money is going to some insurance company, then it's very easy way to track that there is a policy linked. You may
Yeah.
not know the nature of the policy, but then at least know that the policy exists.
Perfect. It's a good point. And there are certain reasons why an insurance company can reject a policy. And
Yeah.
can you help us through that as
Yeah,
well?
so I guess now that the new law is come into play, right? Like after 3 years, it is impossible for an life insurance company to deny a death claim, right? But I guess the major reason is misrepresenting yourself to the insurance company in the first 3 years. That can be the cause, right? Whether misrepresenting financial facts, which means by not accurately disclosing your income or proof sufficient to that income which is declared. Secondly, is any underlying health condition which you have not declared. Now, the gray area is that if you didn't know you had a condition, what you would not technically declare it within this 3 years, right? Hence, goes back to my previous suggestion, right? To take a medical test when you're taking a life insurance, no matter what.
So it makes sense to actually declare your full conditions as said, but that applies only for the first 3 years. After 3 years, an insurance company can't deny, even if if they have discovered later that you had a heart problem and you didn't disclose it. After 3 years, they cannot deny you.
Yes, that is what the current change
New
in.
law has changed. Okay, so this is so of course, declare, because you don't know when you're going to die. That's the idea of taking term life insurance. And the second part is that the insurance companies can reject for these reasons. They could probably reject for other reasons as well. And what is your redressal then? What happens after this?
Yeah, typically you have an IRDA ombudsman who you can approach immediately, or a grievance cell at IRDA. And then I guess most of us will have to go through the consumer court and consumer forum, right? Where you go to district consumer court, then state, and then national, and eventually you can approach the Supreme Court after all of this.
Yes, and I mean, at one point, I think we had written an article in Capital Mind about how somebody had gone all the way to the Supreme Court for this. But it's interesting because, I mean, there are various stages where courts can grant you, relief.
Yep.
And typically, as much as I have seen, most cases where at least there's no obvious fraud, where there is obvious fraud the courts will actually side on the case of the insurer, but if there's no obvious fraud, they tend to side on the case of the individual. But here is where one part of this entire process comes in and says, well, what's the maximum amount of insurance that is possible? I mean, if your insurance you said is limited to, say, X% of your income, or X multiple of your
Multiple
income,
of your income.
and your income changes, it goes up, or you lose your job. Can you apply? Can you do anything with respect to that?
To increase your insurance?
Yes.
Technically, if you we discussed this earlier, right? Like it depends on your financial underwriting, right? So if your income reduces suddenly during that contract, what you sum insured they have granted to you, that they cannot take it away from you. So any material change in income after the policy is issued is immaterial to some extent to the insurance company.
I see. I see.
In that
So it's
manner.
not. It's not. So in a way that they can't increase your insurance either. You just take another policy. I
You take
suppose.
another policy to take more insurance if you want to.
And should you take these from the same company? Should you take it from different companies?
Okay, that's an interesting question, right? Like we all like to diversify risk, right? If you're
Right.
buying a large policy, and then you may want to split it across 2 or 3 companies, but that also comes with an additional inconvenience of having to go through medical underwriting and medical test again,
Right.
right? If you do that, and some of these companies now do telemedical if you fall under certain criteria and under certain age group and everything, but then that sort of then puts you in that gray area for 3 years, that if you didn't know you had something and then you got diagnosed, then it can be a cause to reject your claim, because it's misrepresentation, right? It's not that you knowingly did it. So it's best to then subject yourself to a medical test, take the insurance, then at least you're sure of some of these things, right? Because if an underlying condition gets discovered, your premium can be readjusted, or the insurance company can tell you that this is the cause why we are readjusting your premium or increasing your premium, and you have an option to either take it or ask for a full refund.
So you can actually say, listen, you said you'll pay me, you'll charge me, say 10,000 rupees of premium, and they come back and say, no, you have to pay 15,000 because you have this medical condition. You can say, no, I don't want your insurance. Refund me my 10,000, and
Yes,
they'll refund.
I guess
you.
in most cases they will refund the amount minus the medical test charges, which are nominal in most
I
cases.
see, some
Right?
thousand or something.
Some, but at least you they give you that option, right? And you have a choice now to make.
Yes, and nowadays they actually give you the medical reports as well. Because
Yes,
if I-
definitely. All of them share their medical reports immediately, right? Like, and they have to disclose it to you. It's your medical report
It's your medical report. That's it.
at the end of the day.
Good point. Okay. So I think, as much as we've covered this, and I think this is the part where a lot of people will be individually buying policies. Let's end with this new and maybe interesting concept which you told me, which I had no idea before I met you today, about how the scenario is right now with a certain kind of policy called a group term life insurance, where people, often tell us, oh, my company has a term insurance on me, so I don't need my term insurance. But we'll come back to that. But what is this group term insurance?
Group term life is an insurance which typically a company will buy for its employee as an employee benefit.
Oh,
Right.
okay.
And what that does is that the company, it's an annual contract, first of all, unlike your individual policies, where you decide to get to choose the term or the age till which you want to be insured.
So you renew it every
year. It has to be renewed every year now. The premiums on group term life are typically very aggressively priced,
I see.
right, compared to your traditional products. But the downside is, like, imagine in a pandemic like we are in right now, right? And we don't know whether there's going to be a third wave or there's not going to be a third wave, right? A lot of people have not got the renewal for their existing group term life if there has been a single death in a company, which is
Wow.
likely to happen, right? Here's where while the company gives you this as a benefit, the company is a policy holder.
Correct.
And the insurance company has a contract with the company and not you individually.
Right.
Right? So they can decide on whether they want to renew this annual contract at the time of expiry. Or they may quote an amount which may be depending on the risk they have or exposure they have, based on how they price your entire business or the salaries which you're paying out, right? Because the same sort of underwriting happens for group term life also, right? You need salaries for financial underwriting, and then you're typically giving a multiple of the salary, 1x CTC, 2x CTC, up to 5x CTC to the employee who's the beneficiary.
I see.
And there's also a concept of free cover limit, right? Where in most cases the free cover limit is that the person will not be subjected to a medical test in case the free cover limit, if the sum insured is below the free cover limit.
I see.
Now what this pandemic has done is thrown this entire industry into a spanner,
Oh, wow. Okay.
because no one expected so many people to die, right? So a lot of life insurance companies, as you would have heard, that Kotak Life has gone ahead and declared a quarterly loss, right?
Right.
And they have gone ahead and given a bleak outlook, at least for this year, because they don't know whether the third wave is going to happen or is not going to happen. And a lot of these life insurance companies are sitting at massive amounts of claims which they have to pay out this year,
Yeah, I saw the numbers. It was just
right? How do we price risk now in such a scenario, right? And there's also a cap where the regulator is not going to try to protect the consumer in terms of how much you can charge on the higher side of things, right? And where does this industry go now from here, right? I don't have an answer to this today. I guess only time will tell, because the actuaries will have to go back and see how do they price risk, right? How do you see, are we going to see a world where there are going to be more pandemics? If so, at what intervals? And if so, what is the mortality rate going to be in some of these pandemics, right? And that will have to be priced in, which means term insurance is going to be more expensive.
it has already become.
It has already become expensive, but it is going to be even more expensive, right? And also another part we all should realize, right? Your personal insurance will be very handy in all of these cases, right? While you're depending on your company for this insurance, but if no one's willing to sell to your company because it's an annual contract, you're left exposed, right, with the risk.
So you should technically have your own insurance.
Yes, I always insist, right? Like that way you're the owner of the contract on one side, not the company. A, that. B, you define the terms, right? And you are taking that cover for yourself. Versus when a company buys it, now they may go through a good time and a bad time, and they may want to revise the cover also. That also leaves you exposed,
Yes.
right?
So it may not even be a pandemic. It could just be the company not doing well.
Exactly, right? And they don't have the budget for it. But a lot of us are optimists, right? And believe that we've worked for companies which have existed for 20, 30 years, 40 years, right? And nothing's going to change overnight. But in this new DNA age, anything can happen, I believe.
Yes. But having said that, on the pandemic front, is it possible that they come up with term insurance policies where they say, listen, if you die in a pandemic, we're not going to pay?
Anything is possible, Deepak, right? Because it's at the end of the day a legal contract, right? And especially in group term life, you have a lot of reinsurers going ahead and setting terms, and these reinsurers are looking at global losses. They are not looking at only India and deciding on all of these things, right? And a lot of these guys are scared also to some extent, right? Because if there is no way to price this, how do they price something like this? Does the model change, right, when it comes to mortality rates, when it comes to a lot of other factors, underlying factors, right? And in India, as we rightly discussed earlier, right, we don't even base our premium based on the location, right? Someone who's living in Delhi and breathing the air pollution is through the roof versus someone who's living in Chikmagalur, where he's living in the middle of a coffee plantation, breathing really like
Good air.
right? But both of them end up paying the same premium.
Simply because the underwriting standards haven't evolved to the extent, I guess.
I don't think so. We don't even have data, right? Like at the end of the day, these are statistical models which require huge amounts
of data,
right? To do.
I mean, you're right. I mean, how do I know if, for instance, height doesn't affect? If somebody is over 6'5", chances of X are higher or lower or whatever. Or
Right, and medical history or medical records are also right. Like we've now just started like maintaining them in the format where someone else can read it or consume them.
Perfect.
Right.
This has been, a phenomenal discussion. I think, Ruchir, I have come to the end of my questions. So, anything you'd like to leave our listeners with?
Yeah, I guess we came up with it like very impromptu, like D square sort of like that we can end on that note that buy term insurance in case of debt or in case you have dependents, right? Because those are the two main factors which you need to factor in. I guess thank you, Deepak, for having me on this podcast. I guess this was long due because we've had like so many questions which I think we've addressed using this podcast, which will help a lot of people, right? Like and at least it will give them the starting point.
I think this is, it's phenomenal because so much of our communication at Capital Mind is also about, buy term, because this concept of investing in insurance is not good enough. But then there's so many complications in terms. So, for instance, for me, I may be knowledgeable, my wife may not be so comfortable with the financial world. So, I should actually be using an agent, is something I discovered, say, in the course of this podcast, because I won't be there if my term insurance is to be
Exactly.
claimed.
And it helps, right? Like all of us, we are thinking like there's a cost of convenience, right? We need to pay, right? At the end of the day. And like I would be happy paying that cost if it's to the right person,
Exactly.
right? And figuring out the right person can be very easily done by just doing a reference check, by knowing someone who was bought from them, or by just reading about them and what they think and what how they approach a problem, right? Or write about it.
Absolutely. In fact, I think for that, I mean, I would say visit oneassure.in. They have, a very vast range of financial insurance products that they've got, and I've personally used it, so I'm very biased. You have to assume that I'm on Ruchi's side here, but do definitely visit oneassure.in. And as we come to the end of this podcast, I'd like to also say, please visit capitalmind.in. We have a bunch of articles, pre-Capital Mind Premium as well, where we have articles for premium subscribers and a great Slack community to boot. There's a discount code for those of you who have made it through this much of the podcast, CM Podcast. Use that for a discount at Capital Mind Premium. We'd love to hear more, and thanks again, Ruchir, for coming in on the show.
Thank you so much, Deepak.
Great. And thanks everyone for listening.